Hi, on behalf of HDIN Research, we are pleased to present our 2026 Strategic Advisory Report on PETRONAS Chemicals Group, titled Navigating the Petrochemical Cycle. This analysis evaluates PCG's performance through 2024 and provides a strategic outlook for the 2026 fiscal year, focusing on resilience and long-term value creation. We begin with the situation. The global macro landscape in 2024 remained resilient with a 3.2% GDP growth rate. While energy dynamics have stabilized, PCG achieved a record revenue of 30.7 billion ringgit. This indicates strong market participation, despite the broader industry downcycle. However, the complication lies in margin compression. EBITDA margins tightened to 12% due to lower product spreads and unrealized forex losses. Operationally, while plant utilization improved significantly to over 90%, a rise in safety incidents has prompted the management to enforce stricter safety frameworks. Breaking down the revenue mix, olefins and derivatives lead in volume, bolstered by the Pengerang startup. Fertilizers and methanol remain the primary quote-quote cash engine, with 2.6 billion ringgit in EBITDA, while specialty chemicals represent a growing but still developing high-margin frontier. This leads us to our core strategic inquiry. How can PCG effectively accelerate its diversification into specialties without compromising the operational integrity of its massive commodity core in a volatile market? The resolution is a two-pronged growth strategy. First, sustaining the basic petrochemical core through greater than 90% utilization and commercial agility. Second, diversifying into specialties by leveraging global R&D and the full integration of the Zibo facility in China. PCG's value creation is supported by 6 capitals. Notably, its financial capital remains robust with 9.9 billion ringgit in cash, while intellectual capital has yielded 18 new product launches in the past year, proving the effectiveness of its R&D labs. PCG holds a significant advantage in cost competitiveness and global footprint. The strategic gap remains in the innovation score relative to global specialty leaders, a gap the TIC centers are specifically designed to close by 2027. The Pengerang complex is a game-changer. Reaching commercial operation in late 2024, it adds 2.45 million tons of annual capacity. This scale allows PCG to capture significant market share in the high-growth Southeast Asian polymer and glycol markets. Sustainability is no longer a peripheral goal. PCG has abated 151,000 tons of CO2 and is expanding its circular economy through advanced recycling. These efforts have maintained their inclusion in the FTSE4 Good Index for over a decade. Financial discipline remains a hallmark of PCG. With an 88.5% dividend payout ratio and a low gearing of 8%, the group maintains a healthy balance between rewarding shareholders and keeping "dry powder" for potential M&A opportunities. The risk matrix identifies operational reliability and market supply expansion as high-level threats. Mitigation focuses on deploying digital predictive tools and optimizing the sales mix to hedge against regional demand fluctuations. Digitalization acts as a multiplier. From 5G-enabled plant tools to the CDEX digital booking system, which reduced logistics idling by 20%, technology is directly improving both the customer experience and bottom-line efficiency. Geographically, PCG is deepening its roots. Expansion in India and the unification of operations in Greater China provide proximity to the world's most intensive chemical demand centers. Southeast Asia remains the cornerstone, representing 69% of total sales. Governance standards remain high, with 50% board independence. The group's commitment to zero-tolerance bribery and international reporting standards has earned them multiple global awards in 2024. The 2025 to 2027 pipeline is robust. Key projects like the melamine plant and isononanol facility are nearing completion. The strategic focus is shifting toward downstream applications in the automotive and medical sectors. Looking ahead to 2026, we see cautious optimism. While bearish sentiment persists for olefins and new carbon taxes are looming, the full commercialization of Pengerang and firm urea demand provide strong tailwinds for the group. In summary, the investment thesis for PCG rests on 3 pillars: its structural feedstock advantage, the strategic pivot to high-margin specialties, and its leadership in the ESG transition within the ASEAN region. This analysis is based on integrated financial reporting. Our objective was to provide a transparent view of PCG's ability to sustain value through innovation and operational discipline. Thank you for your attention. For deeper market research or bespoke industry analysis, please contact HDIN Research at sales@hdinresearch.com. We now open the floor for any questions.